Hey, Larry. Anyway, soft openings. I used to own a restaurant, which was the stupidest thing I ever did in my entire life, with one exception, and that's my first wife, which we won't go into. But anyway, when you have a restaurant, it's common to have a soft opening. That means you're not really publicizing your grand opening. You're not hanging banners and whatnot. You're inviting friends, family, maybe a few strangers in, so you can test, make sure everybody knows how to make the food and how to serve the food and all that sort of thing. In other words, you want to make mistakes with a few people and then, obviously refine your business plan. And so that's what we're doing right now. We're having a soft opening because I've done TV news for 30 years. So I've been on camera a lot, but I've never done Facebook Live. And we've actually already managed to screw things up a little bit this morning, but we'll try to do the best we can. I'm going to have to put my spectacles back on so I can see who's here. Okay, good. We've just got just a few of us now. Hey, William. So tell me, where are you guys from? Where's everybody from? I'm in Fort Lauderdale, Florida. Yachting capital of the world. Where are you guys from? Let's see. Tell me. Nobody wants to tell me where they are? I'm not coming over. Anyway, what we're going to talk about today, hopefully, we're going to talk about whatever you want to talk about, first of all. But what I have in mind, I have an outline which we can depart from at any time. But obviously what we're going to talk about is the huge interest rate decline that just occurred. So I want to talk basically what just happened, why did it happen, how is it going to affect you, and what you should do about it right now. So I'm going to take a wild step. Actually, let me give you my credentials first. That's what my notes say to do. I started Money Talks in 1991. We started as a television news service. So in other words, I would make syndicated news stories and I'd feed them to TV stations. So it's on about 80 TV stations. And I did that for 30 years. I stopped doing it last year or the year before. I say because there was no more money in the news business, which is partially true. But what's also true is I wanted to get out of TV before high definition came along. And when 4K came, I'm like, dude, move the camera back. I'm not looking good. So anyway, I got off of TV a couple of years ago and now basically just run this website. I've been a CPA since 1981. And I also worked as an investment advisor for two major Wall Street firms, E.F. Hutton. I don't know if you remember them, and Shearson. Both these companies are now out of business. Anyway, I was a Wall Street investment advisor for 10 years. I've earned licenses in securities supervisor, options principal, commodities, life insurance, and real estate. So I've been giving money advice professionally for about 45 years. So now, let me see what you guys are. I have to look over, put my glasses back on, and look at your comments. Okay, Alabama, California, awesome. Lakeland, Florida, Great Falls, Montana. God, this is so cool. I've never done anything like this. It's cool. So people from all over Dubuque. Dunedin, Florida? I don't even know where that is. Anyway, that's Alex. Hey, Alex. I want to say hi to everybody and thanks for helping us do this thing. And hopefully it'll be fun and we'll be able to do it again in the future. But let me go ahead and start talking about interest rates. As I'm sure you're aware, unless you live in a cave, the Federal Reserve lowered interest rates by 50 basis points, 0.5%, a couple of days ago, bringing the Fed funds rate from 5.5 down to 5. That sounds like blah, 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 right? But it's really important. But let's start with what the Fed funds rate is. I'm not going to, this isn't a college course. So basically the Fed sets interest rates and they have two mandates. One, to keep employment as full as possible. And two, to squash inflation, keep inflation under control. Okay, so what happened on Wednesday was that for the first time in 4 years, the Federal Reserve reduced interest rates. And that's telling you something. What it's telling you is the Fed was freaked out about inflation, right? As all of us were. And so they kept raising interest rates to fight that inflation. But when they start lowering rates, what does that tell you? It tells you that they're going in the other direction. Now they're not concerned about inflation as much because inflation has come down. So what they're concerned about now is jobs. Because if rates stay high and the economy slows down as a result, people can start losing their jobs. So even though it's a 0.5 point shift in interest rates, it's a big shift in their goals. They were all about fighting inflation. Now they're all about making sure that the economy doesn't go into a hole, doesn't go into a recession. So that's why they reduce rates, and that's why it's important. Immediately put my glasses back on. We'll see if anybody has anything to say about it. And by the way, we can talk about anything you want. I have this set up so we can talk about this, but we can talk about anything. And you can ask me any question, and I really encourage you to, because I do like talking to myself. I've worked alone for 30 years. So I pretend I'm talking to my cats, but I'm actually talking to myself. And I will sit here and talk to myself, but I'd really rather hear from you guys too and talk about whatever you want. So anyway, interest rates have now dropped to 0.5 point, and they're probably going to continue to drop. My guess would be that they're going to drop 2 more times this year, probably by 0.25 point each, and maybe 4 more times next year. So the interest rates are going to go down significantly. Now, what happens when interest rates are cut? Here's something super important to know. The Federal Reserve does not control all interest rates. They only control one, and that's the Fed funds rate. That rate is the interest rate that banks pay each other when they borrow from each other. We won't get in the weeds on that. But anyway, the Fed funds rate has nothing to do with you or me. So that's the only thing the Fed controls. They don't control mortgage rates. They don't control car loan rates. They don't control long-term bond rates. All they can control is this one super short interest rate. In other words, this is interest rate literally overnight that banks are paying. But now what banks do is they take that Fed funds rate and they add about 3% to it. And then that's called the prime rate. There's no law that says it has to be 3%. They may take that. So right now, let's back up. Right now, the Fed funds rate is 5%, essentially. It was 5.5%. Okay. So now it's 5. Banks add 3 points onto that, and the prime rate becomes 8. Now, they could add 5 points onto it if they want. They can do anything they want. But generally, they add 3 points. So now, who gets the prime rate? The most secure borrowers, big corporations, usually rich people. In other words, most people don't even get the prime rate when they want to borrow money. But when the prime rate changes and it just lowered by 0.5%, then that's going to change a lot of other rates. It'll change the rates on car loans. It'll change the rates on credit cards. It doesn't directly change mortgage rates, except if you have an adjustable mortgage. It can change those rates. And it's going to take time for all these things. But let's talk about CDs. Now, when they lower that rate, when the Fed funds rate goes down, are banks automatically going to lower their rates on CDs? They probably will, but they don't have to. So in other words, let's say the bank is competing with another bank, and one bank lowers their rate. The other bank may just keep their CD rate, 1-year CD rate at 5. They can't do that. Ultimately, obviously, as rates go down, universally, then rates are going to start coming down on our savings stuff too. Let me look over here. Is this a sign of recession? Well, this is what's interesting about interest rates too. Interest rates come down because the Fed is trying to stimulate the economy, right? When they raise interest rates, they're trying to slow the economy down, literally like putting your foot on the brake. And then when they lower interest rates, that's like putting your foot on the gas, right? So the reasons that they lower rates can be to stimulate the economy to try to prevent a recession. But they also may just lower rates like now. We're not really close to a recession, at least from what I'm reading. But rates are higher than they need to be, and the economy is gradually slowing, and the Fed wants to head that off by lowering rates so we don't get into a recession. But generally speaking, lower rates are good for the stock market for several reasons. Let me make sure I got everybody. Nope, stock market takes the low rate is good for economy. William, that's really good because what can happen when you see rates go down is one of two things. It could be really good because businesses make more money when interest rates are lower, obviously, for several reasons. First of all, you and I could buy more crap because we can, finance the finance the purchase at a lower interest rate. So we're going to buy more. That makes them more profitable. Also, they borrow money, which makes them more profitable if they have to pay less interest, right? So lowering rates can be really good for stocks. But on the other hand, if the Fed is lowering rates because the economy is going into recession, well, recessions aren't good for stocks. So if the economy is slowing down, that's bad for stocks. If the interest rates are going down, that's good for stocks. So which is it? Are lowering rates good or bad for stocks? And the answer is yes. Who knows? I mean, it could be either way. And yet, in fact, you've seen that. On Wednesday, when they lowered the rates, the stock market tanked, didn't it? And then yesterday, the stock market took the opposite view and said, oh my gosh, rates are low. Companies are going to be more profitable. And they bought the hell out of the stock market. So it's really hard to know. I mean, lowering rates doesn't automatically. I can tell you this, though. Historically, when rates have been cut, especially when the stock market's at highs, it goes up. The average return is 18% over the next year. Since like 1970, that's been the case. So generally speaking, low rates are good unless the rates have been lowered because the economy sucks, if that makes sense. So right now, who knows? I mean, the stock market's down a little bit today. Anyway, let's see. Hope we have a soft landing. Thanks for bringing that up too, William. A soft landing meaning we managed to slow the economy enough to crush inflation, but not so slow that we go into a recession. That's what's called a soft landing. And I would argue that we're almost there now because we're sure not in a recession, and interest and inflation's back down to close to 2%. So that would be a soft landing. And I think now some people are saying, no, it's going to keep going. The economy's going to get worse and worse, and we're going to go into a recession. That means we would have a hard landing. But I think we've engineered, or me, but Jerome Powell has engineered a soft landing. Okay. Well, thank you, William. Money Talks gives lots of practical information and advice. I appreciate that. We try. Okay, I'll continue unless I get other questions. Have I answered everyone's questions so far? Well, this is a good question. Will the upcoming election have any effect on interest rates? Well, the election should not affect interest rates at all. And I'm sure if you pay any attention to politics, I'm sure you've seen that Trump has said they lowered interest rates just before the election because that obviously makes Kamala Harris look better. I mean, the economy's better and blah, blah, blah. You're happy if your interest rates go down on your credit cards and everything. And so some people, almost universally, whatever politician is not favored by an interest rate cut claims the other side is gaming the system. But in my opinion, which could be wrong, but I've been a Fed watcher for many years, and the Fed does what the Fed does. They're completely independent. They're not doing anything because of an election. And so, I don't think that they're a political outfit whatsoever. And what's actually kind of ironic, too, is that Trump is saying that he's pissed that Jerome Powell lowered rates. Jerome Powell's a Republican who he appointed. So this doesn't really hold water to me. And okay, William said, well, actually, let me specifically answer the question. Will the upcoming election have any effect on interest rates? No, it shouldn't. It shouldn't. And even the stock market, people think, well, the Fed's going to look at the stock market. Let's say the stock market takes a huge dump because of whatever happens in the election. Well, isn't the Fed going to come and try to stimulate the stock market? No, it's not their job. They don't care about the stock market. They don't care about the election. All their whole job, I just told you, two things: to keep employment as high as possible and to keep inflation as low as possible. That's it. They don't care about the stock market. Stock market goes down, it goes down. They don't care. And the unemployment rate, William, is very, very low. And that's a good thing, of course. It's obviously been lower. I think it got as low as 3.5%. Now it's 4.5 or 4.3 or something like that. Anyway, employment's low historically. And as long as it stays under 5, and it probably will, the economy is fine. Now, let's talk about something, though, with the stock market especially. I'm a huge stock guy. I don't know if you guys know this. I own like 35 different stocks. I own some mutual funds as well, but I'm a stock guy. So I look at the stock market all day, every day. I watch CNBC at night. I mean, I'm huge into this. And I really like it. But anyway, the point is, since interest rates are now falling, would that make stocks go up? Generally speaking, I told you, probably will. because companies get more profitable. But, and this is a big but, maybe it already happened. I mean, the stock market's up 20% this year. And that was largely in anticipation of lower rates. And historically, the market typically trades historically at about, I think it's 15.7, call it 15 times earnings. So the S&P 500 generally trades at about 15 times the earnings of all the companies within it. Okay. Now, right now it's trading at 21 times earnings. So that's historically high. So just because they lowered rates doesn't necessarily mean the stock market's going to immediately go up. It did yesterday, but it's not. It may have already digested lower interest rates into stock prices. So I'm not a huge buyer of stocks here. In fact, I try to buy stocks when everything sucks, when the sky is falling, and I made a lot of money doing that. The last time I bought, I bought NVIDIA during the pandemic, and I put in 10 grand, so that were 220 grand. And I bought in 2009 when the market tanked then. So I'm typically not a buyer of stocks when the market's trading at 21 times earnings. I'm not a seller, but I'm not a buyer. That's where I am here. Anybody have any other questions? You're making me talk a lot. Making up my own stuff. Okay, so now we know what happened, and we know why it happened, because policymakers are more concerned now about the economy than they are about inflation. How will it affect you? Obviously, two diametrically opposed people here. If you're a saver, like me, and I suspect like most of you guys, then this is obviously not going to be great news for us, because I was earning 5% in a money market fund. And that's fine with me, because I'm at the stage of my life, I'm 69. You ever heard this Will Rogers quote? I'm at the age where I'm more concerned with the return of my money than the return on my money. So earning 5%, and I also had treasuries, but just in money market, was awesome. Now, obviously, these rates are going to come down. They don't have to come down today, but they're going to come down. So that easy 5% is not going to be around for that much longer. So that's bad for us savers, although, as I said, could be helpful for the stock market. Now, if you're a borrower, obviously, you want rates to go down. So it's good for borrowers when rates go down. Probably mortgage rates are, again, in anticipation perhaps, mortgage rates are around 6% now, and they were as high as almost 8%. So mortgage rates have already dropped a bunch. And again, Federal Reserve doesn't control that. It's the market that does. So borrowers are in much better shape now. Of course, if you're paying 24% interest on a credit card and interest rates drop a half a point, well, you're still screwed. Just maybe not as painfully, but still screwed. So you really want to get your debts paid down. But I expect the rates are going to continue to go down, like I said, for at least the next year. Let's see, what's this say? Try to like, okay, yeah, what should you do? That's my next topic. But anyway, how it affects you. Saver we went over, borrower went over, stock market we went over. How about the bond market? Now, one of the things I did was I bought some bonds. I'm not a huge bond buyer, but now I'm getting old, so I'm going to have to start looking at income. But bonds do well when interest rates fall. Why? Because obviously, if I've got a 5% CD and the best you could get is 4%, then my CD is more valuable than yours, right? Same thing in the bond market. So what I did was I bought some bonds to take advantage, because they'll become more valuable as interest rates drop. And I can sell those bonds for a profit. Not to mention, I can lock in those rates. So one of the things, let's go back into what you should do then. If you're a saver, you need to be locking in rates right now, today. I mean, if you want a 5% CD and you can find one today, you should buy it. Providing obviously you're not going to need the money. Or you could go and buy bonds, or you could buy bond ETFs. I bought a couple of them. In fact, I just checked them before we went on. I bought maybe 50 grand I put into actually junk bonds. They're lower rated quality bonds. And I did that a couple of weeks ago, and I'm up a few $100. Not a ton. But, as interest rates fall, the bonds become more valuable in those ETFs. And I hope hopefully I will lock in higher rates, and maybe I can make a little money. So that's what I've done. So that's what you should be doing now too if you're a saver. Let's see. What does Mike say? I only own 10 stocks. Several have done very well. I'm interested in selling to take a bit back and use it for fun and invest in additional stocks. If I sell, I believe I need to make 120% to break even on a sale to cover the sale and the tax. I'm not really sure what you mean by that. If you sell, okay, I get that you want to take some profits, which is always a good idea. But you need to make 120%. Oh, in other words, you need to make extra to cover the taxes. Now, remember that your taxes on long-term capital gains are shorter. If you've held it for a year, they're shorter, or they're less than they are on short-term capital gains, which are taxed just like a regular income. But really, a couple of pieces of advice here. Number one, never have so much money in the stock market that you're bummed if it goes down. I mean, really, if you're laying awake at night staring at the ceiling because you're freaked that the stock market's going to drop, you've got too much money in it. Okay? Take some out, period. Never hurts to take a profit. But remember, too, when I was a stockbroker, I was an investment advisor for many years. And you know what people do? They sell their winners, can't go broke taking a profit, and they hold on to their losers, hoping they'll come back. If you've got stocks that are winners, you really need them to be big winners to offset the losses. So what most people do is the exact opposite of what they should do. Keep your losses short and your profits long. I put $1,700 into Apple in 2001. It became worth over $1 million. And do you know how many times over that 23-year period I saw people on CNBC or read articles saying, Apple sucks, you need to get out of Apple? I could have sold that 1 million times, but I didn't. Well, I have sold a lot of it now, but I still have a couple $100,000 in it. The point is, definitely take some profits. Don't have too much money in the stock market where you're freaking out and worrying and staring at the ceiling at night. And then let your profits run and cut your losses short. So if you want to, who is that? Mike. If Mike wants to take some profits, I hardly encourage it. I don't know that there's any 120% rule, but if you can, keep something for a year. But here's another piece of advice. Ignore taxes when it comes to stocks. Don't hold on to a stock so for another 18 days, you can make it long term. Nice if you can, but if you make decisions like that, you could have your hat handed to you. Make decisions based on whether you still want to own that stock or not on taxes, not on how much you paid for it. The reasons you bought that stock still valid? If they are, keep the stock. If they're not, sell the stock. Taxes be damned. Make decisions like that based on stuff like that. Okay, William, single bonds or bond ETFs? I have both. I actually most recently bought bond ETFs. All things being equal, you'd rather have a bond. Because, you could take a treasury, a liquid treasury bond, and you can sell that thing if you want to make a profit when interest rates fall. Whereas ETFs, they may be replacing bonds as they come due with new bonds, which are going to be at lower rates, right? So in an ideal world, if you want to lock in a rate, you buy a bond with, if you get a bond today for 7% interest, you got that 7% interest until that bond matures. Whereas with an ETF, it's going to the interest rates gradually go down as bonds come due and new bonds with lower rates go into the portfolio. So I'd rather have a bond. William also says use the 3-bucket system to reduce risk in the stock market. For those of you who are, oh wow, we only got 2 minutes to 11:30. Okay, that went fast. Anyway, 3-bucket system, having a short-term funds so you don't have to touch your longer-term funds and stocks. If the market goes against you, then you've got some cash to ride it out. And that's a super, super great strategy. Well done. So 3 buckets, short, medium, long. And you've got your stocks in your medium or long, and you've got your shorts, so you don't have to sell your stocks if you need money. And I guess that means we're almost out of time. Well, I hope you guys had some fun. And I really appreciate you helping me do a soft opening on this thing, because we'll do it again if you want to. But I'd love your comments. Let me know, did I talk too much? I tend to talk too fast. So give me your comments, especially, no, I'm just joking. Give me any comments you've got. I appreciate it, folks. And we will see you right here. I don't know the next time, but keep an eye out. We'll let you know.